The CME just pulled the emergency brake. Silver futures maintenance margin just jumped 30%, from $25,000 to $32,500 per 5,000 ounce contract. Gold got hit too, up 1%. That isn't a technical update. That's a liquidity weapon. And when the market opens, the first thing it can create is forced selling. You're with us right now. No small talk, just what matters. Because a margin hike doesn't ask permission, it demands cash. And if traders don't have the cash, they don't get a debate. They dump contracts. Now, a quick clarity check, because this is where people get fooled. Maintenance margin is the minimum cash you must keep in the account to hold the contract, not to open it, to keep it. You can be right on direction and still get kicked out, because futures are marked to market every day. If price wiggles against you, your account gets drained. Then the exchange raises the maintenance line, and suddenly you're below the line, even if nothing else changed. That's when the broker calls. They don't call to discuss your thesis. They call to collect money. And if you can't wire it, they liquidate you at the worst possible time. That is why margin hikes are so brutal. They convert volatility into forced action. They turn a normal pullback into a liquidation spiral. And here's the dirty little secret. A liquidation spiral can create a low that has nothing to do with supply and demand. It's just leverage getting crushed. So when you see silver dump on the open after margin notice, the correct question is not who's selling, it's who is being forced to sell. Because forced sellers are temporary. They sell until they're out, then they're gone. When they're gone, the market is free to snap back. That snapback is what catches most people off guard. They sell the flush, then watch the rebound without them. We're not doing that. We're watching for the pressure to exhaust. We're watching for the moment the selling stops being desperate and starts being optional. That moment is where opportunity lives. Now watch this part closely. An extra $7,500 per silver contract doesn't sound like much until you realize what leverage does to the math. 10 contracts? That's $75,000 overnight. 100 contracts? That's $750,000 immediately just to keep the position alive. So what happens next is predictable. Some players sell a slice to raise cash. That selling pushes price down. That drop triggers more maintenance pressure. And suddenly, the market isn't selling because the story changed. It's selling because the plumbing got tightened. This is how a margin hike turns into a waterfall. And here's the uncomfortable truth. This mechanism protects the people who can fund the spike and punishes the people who can't. So the first question we have to ask is simple. Are we watching a real top or a forced shakeout? Because those are not the same thing. Now, quick disclaimer, and we move fast. This is educational. We manage risk. Nothing here is personal financial advice. All right, let's talk about why this matters and what we do with it. Fact, a margin hike raises the cost of holding paper exposure. Interpretation, it increases the odds of a short-term dip, even if the long-term thesis stays intact. And that even if is the whole game. The market loves to confuse price action with reality. Price action is the scoreboard. Reality is the engine. They're related, but they're not identical. So if we're trying to trade this like adults, we need to separate three things. What the exchange did, what leveraged traders are forced to do, and what the underlying silver story is doing underneath the noise. Start with the exchange. The CME doesn't raise margins because they feel emotional. They raise margins when volatility spikes, when positioning gets crowded, and when they want to reduce systemic risk. But in practice, it's like raising the toll booth price right as traffic hits rush hour. You don't fix congestion. You cause a pileup. And here's the part most people miss. A margin hike is not neutral. It hits longs and shorts on paper, but it usually hurts longs more in a raging uptrend. Why? Because the people chasing momentum are often the most levered, and the people defending shorts are often the most funded. So the squeeze gets interrupted, the chart gets bruised, and the headlines scream, "Silver is collapsing." But collapse is a strong word. Sometimes it's just a forced exhale. Now here's the open loop we need to keep in our pocket. If this was truly overbought mania, why choose this moment to crank margins? Why not wait for calm? Why not let the market cool on its own? That timing tells us something. Either volatility is scaring the exchange, or the exchange is deliberately damping the fire. And yes, both can be true. So what do we watch when the market reopens? We watch where selling comes from. Is it paper dumping into thin liquidity? Or is it real physical pressure, like premiums collapsing and inventory flooding back? Because those two worlds don't behave the same. Paper can vanish in minutes. Physical moves like a tanker ship. So if paper pukes and physical stays tight, that's not a death signal, that's a discount signal. Now let's get practical, because we don't get paid for being poetic. We get paid for being prepared. The forced selling path usually looks like this. First hour, sharp drop, fast candles, panic comments. Second phase, a dead cat bounce as bargain hunters nibble. Third phase, another push lower as margin calls settle and weak hands finally tap out. Then, only then, does the market show its real direction. So if you're staring at the very first red candle and calling the whole move over, you're letting the exchange rent space in your head. We don't do that. We measure. Now let's talk levels, because levels are where emotions get trapped. Silver didn't just drift up. It sprinted. Moves like that create two things: euphoria at the top and unfinished business underneath. Markets hate unfinished business. They love retests. A breakout level that was resistance becomes the first place we test for support. And if that support holds, the move gains legitimacy, not because the universe cares about lines, because humans do, funds do, algorithms do. So the important question is not, is silver red today? The important question is, where does it stop bleeding? And does it stop in a place that keeps the bull structure intact? Now, in the original bull cycles, there's a classic heartbeat. The 200-day moving average is the long-term line in the sand. In slow bull markets, price often comes back to it like a magnet. Touch, bounce, continue. But we're not in a slow bull market right now. We're in a market that's acting like it's late cycle, fast, vertical, aggressive. And in those conditions, price doesn't always give you the polite 200-day kiss. Sometimes it only kisses the 50-day. Sometimes it only taps the 20-day. Sometimes it barely breathes and then rips again. So we need a smarter lens. We use a short stack of moving averages like a ladder, a fast one, a medium one, and a slower one. Think 9-day, 20-day, 50-day. Not because those numbers are magic, because they show us the rhythm of traders. The 9-day is the heartbeat of momentum. The 20-day is the heartbeat of trend followers. The 50-day is the heartbeat of I'm not panicking money. So here's the setup. If margin hikes trigger selling, price can fall toward those averages. That isn't automatically bearish. It's a test, a stress test. And stress tests reveal truth. If price slices through the 9-day like butter but finds buyers near the 20-day, that's the market saying, we're cooling, not dying. If price loses the 20-day and catches itself on the 50-day, same idea. Deeper breath, still alive. But if price smashes through all of them and can't bounce, then we start talking about a bigger reset. That's the ladder. Now, here's where things get spicy. Margin hikes can create the dip, but they can also accelerate the next leg up. How? Because dips triggered by forced selling are often the cleanest dips. They flush leverage, they reset funding, they transfer contracts from tourists to believers. And when that happens, the market can rebound harder than it fell. It's like shaking a tree. The weak fruit drops, the branches get lighter, and the next gust moves the whole thing faster. So don't be shocked if the market opens ugly and then turns violent the other way later. That's not chaos, that's structure. Now, I want to address the trap that ruins most people right here. Futures. If you're playing silver through futures, you're not just trading silver. You are trading an exchange rulebook. You are trading margin policy. You are trading overnight emails. And that means the game can change while you sleep. That's not investing. That's a casino with moving walls. And margin hikes are the walls moving. So when we say don't get involved, we're not being dramatic. We're being precise. If you want exposure to silver, there are cleaner ways to get it. Physical is the simplest. It doesn't have a maintenance call. It doesn't send you a bill at 2 a.m. It just sits there and waits. And yes, physical has premiums and storage and liquidity questions, but it doesn't have a referee that can change the rules mid-match. So if we're building an exposure plan that survives volatility, we lean away from paper leverage. We lean toward positions that don't get liquidated by policy. Now, another open loop. If silver is just speculation, why does the exchange feel the need to stomp on it with margin hikes? Speculation dies on its own. Real moves attract countermeasures. So the existence of the margin hike is not proof the bull market is over. It's proof the bull market is loud enough to scare someone. Now, we need to keep our takeaways tight. Takeaway 1, the margin hike increases the odds of a sharp dip at the open. Takeaway 2, that dip can be mechanical, not fundamental. Takeaway 3, the key is whether price respects support zones and moving average ladders. Takeaway 4, paper leverage is vulnerable to rule changes, physical exposure isn't. And takeaway 5, volatility is not the enemy. Unplanned liquidation is. Now let's go deeper into the psychology, because this is where the retention battle is won. They will use the first red move as a narrative weapon. You will see posts saying, top is in. You will see clips saying, it's crashing. You will hear the word bubble. And bubbles are a powerful word because it triggers shame. Nobody wants to be the last buyer. So the market doesn't just attack your portfolio, it attacks your identity. And that is why margin hikes work so well. They create a price move. then the media manufactures a meaning, then weak hands self-liquidate. Not because they did the math, because they got embarrassed. We don't play that game. We separate facts from stories. Fact, margin requirements went up. Fact, that forces some traders to reduce exposure. Interpretation, short-term price pressure is likely. Interpretation, if the broader demand story remains intact, the pressure can become opportunity. Now, here's where we check ourselves. What would prove us wrong? If a margin hike causes a dip and physical premiums collapse, that suggests demand wasn't real. If inventories suddenly refill and delivery delays vanish, that suggests the squeeze was mostly paper. If silver breaks key support and can't reclaim it even after volatility settles, that suggests the trend changed. Those are the falsifiers. We don't need certainty, we need triggers. So as the market opens, we watch 3 dashboards: the chart structure, the futures positioning stress, and the physical market behavior. And here's a question for you. Where do you think the real pressure shows first, paper liquidation or physical tightness? Drop your answer in the comments because that tells us what kind of market we're actually in. Now, let's talk about the healthy pullback argument, but without the fluffy tone. When price runs straight up, it creates a vacuum underneath, and vacuums get filled. A pullback can fill that vacuum by retesting prior resistance. That's not a motivational poster. That's how markets recycle energy. So if silver pulls back into a former breakout zone and then rebounds, that's not bad news. That's confirmation. Confirmation that buyers exist without leverage. Confirmation that the move isn't just a one-week firework. And if that confirmation happens, the next push can be stronger because the market has a base to launch from. So we're not cheering for pain, we're preparing for structure. Now, I know what you're thinking. Okay, but what if they keep doing this? Exactly, that's the deeper threat. One margin hike can shake the tree. Repeated margin hikes can condition the crowd to fear any rally. And that fear is the whole point. Because if you can't stop a trend with fundamentals, you try to stop it with psychology. You create motion sickness. Up $3, down $3, up $2, down $4, until people sell just to feel normal again. So our job is to build a plan that doesn't require emotional perfection. We keep position size sane. We avoid leverage that can be destroyed by policy. We focus on levels, not headlines. And we remember what a margin hike really is. It's not a verdict. It's a stress test. Now here's the contradiction that should make you lean forward. Margin hikes can make price drop, while underlying demand is strengthening. Both can happen at the same time. So if you're only watching the chart, you get manipulated. If you're watching the plumbing, you stay calm, and calm is alpha. Now let's talk about timing, because timing is where people get chopped. When markets reopen after a policy shock, the first move is often the wrong move. Not always, but often. Because the first move is driven by forced action, not choice. So if you want to be smart, you don't chase the first candle, you let the forced sellers show themselves, you let the dust settle, you let the market reveal where real bids exist, then you act. That's how we avoid being the liquidity for someone else's margin call. Now we also need to talk about why silver feels different than gold here. Gold margin up 9, 1% is significant, but silver up 30% is a hammer. That gap tells us silver is where the heat is. Silver is the crowded theater. Silver is the sprinting runner. And that means silver is also where the exchange is most nervous. So even if you love silver, you have to respect that it is the more violent animal. It moves fast, it punishes impatience, it rewards planning. Now, one more retention beat before we move into the action plan. If the exchange is raising margins, someone is exposed. The question is, who? Are overlevered longs the target? Are underfunded shorts the risk? Or is this simply the exchange trying to protect itself from both sides? We'll know by the follow-through. If price dips and then recovers quickly, that suggests forced longs got flushed and real buyers stepped in. If price dips and keeps bleeding, that suggests positioning was too crowded and needs a deeper cleanse. So we watch the tape. Now here's the action plan, and we keep it tight. 1. If you're in paper leverage, understand you can be forced out by policy, not by thesis. 2. If you want exposure, consider instruments that don't have maintenance calls. 3. Map the support zones where a retest would be meaningful. 4. Watch the moving average ladder for how deep the market needs to breathe. 5. Track physical signals, premiums, availability, delivery times, because they don't lie the way paper does. And yes, if you want us to keep breaking these events down in real time, hit subscribe. No fluff, just the signal. And one more thing we can't ignore. Watch open interest after the hit. If price drops and open interest collapses, that's leverage being flushed. If price drops, but open interest stays stubborn, the pressure may not be done. Also watch volume at the lows. Real bottoms trade heavy, then go quiet. Fake bottoms trade quiet, then break. And if the exchange hikes margins again after this, that's the tell that the fire is still burning under the floor. Now let's end where the real suspense lives. The margin hike email is the match. The open is the gasoline. And the first hour is the smoke test. If we see a hard drop with fast stabilization, that's the market saying, nice try. If we see a hard drop with no bid, that's the market saying, we're not done cleansing yet. Either way, the next move won't be about what you hope. It'll be about who gets forced to act. So here's the final question. When the market opens, do you think this margin hammer creates a buying window or the start of a deeper shakeout? Tell us below, because the answer will show up on the chart before it shows up in the headlines. So keep your eyes open. And when it does, we need to be ready before the next margin email hits.